All right. Welcome to the last live panel of day 2 of Financial Inclusion Week. To the audience that's joining, please, we intend this to be as interactive as possible. So do add your questions and comments in the chat. And I do want to extend a warm welcome to Vikas and Jacob, two people who I really admire and have enjoyed speaking with. Thank you very much for joining this panel. To start us off, I'd love for you to actually introduce yourselves and tell us a little bit more about your work and your journey, and what made you agree to join this panel on predatory lending. Should I call or would you volunteer?
Go ahead, Vikas.
Sure. Hi, everybody. It's a pleasure to be here. Jayshree, Jacob are both old friends in this world of financial inclusion and fintech, and excited for the conversation. My name is Vikas Raj. I'm a co-founder and general partner of a firm called Resilience VC. We're a U.S.-based and U.S.-focused fintech, seed stage fintech venture firm that is explicitly focused on investing in visionary entrepreneurs that are building financial services for everybody. And when we look at a company, a potential investment, we really try to tie the product or service, the financial service or the financial product that company provides to a customer to financial resilience. And we'll talk more about what that looks like. I'm part of this panel because Jayshree and Jacob were nice enough to invite me to join, and because I think we're in a really unique moment in a third wave of what it looks like to be providing financial services to low-income and underserved people in the U.S. and around the world. I think it creates big new risks, but also big new opportunities, and I'm excited to share a little bit about what we're seeing.
Thank you. Jacob?
Yeah, well, thanks, everyone. Thanks for being here, and really appreciate being with you all today. I started out thinking about financial inclusion and predatory lending really at the same time, which was for me after graduate school. I moved to Azerbaijan and worked for a microfinance lender that was run by Save the Children. And so I was sort of grappling with many of these issues at the very beginning of my career in thinking about, loan officers going out to open air marketplaces. And we were a humanitarian organization trying to run an economic opportunities program. And we were grappling with what kind of interest rate to charge and how to communicate, and flat versus declining interest rate ways of quoting it. And so I think, this was 2004. And so it's been a little over 20 years that I've been still grappling with many of the same issues that I think we're going to talk about today. The work has changed for me. Mike Hokinson, my longtime co-founder, and I started a microfinance investment manager 20 years ago called Minlam Asset Management. And then after being acquired in 2012, we started Community Investment Management, which really looks at financial inclusion through the innovation of fintech and how fintech is potentially able to improve on many of the models that we, Vikas and many of us in this space have been working on for decades. And there's a lot of promise and there's a lot of risk, as we'll talk about. There's, which is great. But just really grateful to be here and be working with everyone to try to, continue to innovate and also grapple with many of the tough questions and trade-offs. And then I just wanted to give a quick shout out to Malika Anand, who really, while she's not on the panel today, was the brainchild behind all of this and brought us together as we've been grappling here at CIM, Malika and our team, with many of these questions as we look at investments day in and day out.
Yeah, I was going to thank Malika at the end, but yes, thank you to her. I'm really grateful that both of you are part of this panel. And actually, you both alluded to something that happened 20 years ago. And, we're all aware in the sector about predatory lending being a problem even back when microcredit was launched. We've now moved ahead in terms of numbers. You've seen, access rising. More people have access to accounts and mobile money wallets. But even as these rates have gone up, and even as we all believe in the potential that technology holds, we've seen lots of challenges come up. And a large part of this is, I mean, according to me, I think predatory lending is something that as a sector we have recognized, we haven't quite defined. And I was looking for a definition as I was preparing for this panel, and I didn't find one. So I thought we might use this to define it, or at least describe it. I think defining it is a bit pompous, but we can describe it. And I'd also like to know from both of you what you have seen, because you've both been investors for a long time now. What have you seen as more enduring problems? Things like interest rates, presumably other things. And what is driven by this use of technology and financial services?
I'm happy to start, Jacob, and then please jump in. Maybe I can start with just like a description of, in my view, what's happened. So, Jayshree started to take us through microfinance. Jacob discussed his background in microfinance. I also come from the microfinance world. I started my work in this space working at what was at the time a startup micro lender in Bangalore called Ujjivan that has gone on to become a pretty big MFI. And I think the through line from the pre-microfinance days to the microfinance wave to the sort of Fintech 1.0 wave to now where we are today, which is, I would describe as sort of a new era of embedded Fintech 2.0, is that the connection between a loan, borrowing money, and then repaying it with a certain interest rate, and its actual costs and the terms around it are just getting increasingly refracted through technology. Mm-hmm. Every wave is making it harder to know really what that loan is, whether it's a loan at all. It also, every one of these waves creates incredible opportunities, incredible promise for further inclusion with more products available for more consumers at the right time, but it makes it harder and harder as a borrower to know what you're getting. So, I think you described, Jayshree, microfinance, incredible business model innovation, included so many people in the financial system formally for the first time, but also added a layer of new complexity versus a local money lender. Local money lender, it may have been exploitative and incredibly expensive, but you kind of knew what you were getting. You were taking a loan, and in 3 months, 6 months, a year, you were repaying it for a lot of additional interest. But microfinance included all of a sudden things like insurance and group liability and other fees that at times led to things like those of us that have been doing this for a long time, things like the Andhra crisis, incredible over-indebtedness. So it wasn't always a perfect picture. I think the second wave of innovation in financial services was this Fintech 1.0 wave that Jacob started to describe, where with your feature phone or your smartphone and the internet, all of a sudden, you could access, understand, and serve many, many more consumers as an operator. It was this incredible moment and wave for financial inclusion, but again, another opportunity to add abstraction between what the core product was, the core service was, and the borrower. I was really lucky to lead Exion Venture Lab for many years, where we invested in many of these sort of wave of fintech startups. Companies like Confio in Mexico, providing small businesses their first loans based on new government tax data. Companies like iFinance in India, providing small businesses financing around a cluster-based sort of vertical approach. Incredible leap forward in terms of inclusion, but again, also many new issues around over-indebtedness and a lack of transparency were sort of exposed. And now in my view, we're in a third wave, which is truly embedded and frictionless finance, where lending is happening inside everyday experiences, wherever you work, wherever you pay, wherever you invest. And that is leading to, it's not even abstraction, it's nearly invisible finance now in many, many situations. You take BNPL as an example, now a massive part of the US economy, which is companies like Affirm and Klarna here in the United States that allow you essentially to buy anything on installment plans. Jacob and I are getting older, but if you're like Gen Z in the United States, 2/3 of Gen Z millennials are using BNPL to buy things. And by the way, over 40% of them are paying late. And with BNPL, there's some really responsible players. There's others that for whom fees are not transparent. Whether or not the loan is reported to your credit bureau is not quite transparent, and it's leading, we think, to really, really big issues with late fees of 40 to 60% compounding APRs. So that's a pretty glaring example of how lending has gotten more frictionless, more easy, more inclusive, but not necessarily better as the true product is sort of abstracted from what the borrower actually understands. So that's where we are in my view.
No, I definitely see the trajectory of more complexity with the products, to the point where even building off of that, like, it's not clear necessarily really what lending is versus just what commerce is anymore, right? So like if you have embedded BNPL, buy now pay later, on online marketplaces, or for example, you go to the doctor's office and you get financing for that. There's multiple variables that can be adjusted to get to quote unquote pricing, right? Like you could have free financing, but at the end of the day, they just mark up the cost of the product on the other end. And it gets to the question, when you look at marketplaces, for example, many of us buy packages that show up at our door on e-commerce sites. There's a lot of additional price added into that for other ancillary services, like, for example, free returns, free shipping, right? Like all of those things. We don't think of that as cost of financing per se, but as you embed financing into those types of marketplaces, all of a sudden you see free financing with the same price as those products on your e-commerce site, but without necessarily the benefits of free returns or free shipping. Like there's just so much complexity in the way that financial products have been embedded into commerce that it's difficult actually just to talk about lending. Like it is just truly economic activity and the costs that come into that. And so taking a step back and going to this question of what is predatory lending, because of all of this complexity, the way that we think of it is going back to some basics, right? Like you just go all the way back to core principles. And there, what we're grappling with is just really, it comes down to financial health. Like, is the person potentially better off than they are going to be, by using the product versus not using the product? And I know that that's a very simple framework, but that's the only one that we can use to make sense of all of this, right? And so you ultimately come down to, for example, if it's a business loan, like, is this productive versus extractive types of financing? Like, is the underlying activity yielding enough return on the investment to justify the cost of the financing? Like, that's one core principle that you try to get at. But there's, because you mentioned resilience, that's something you've done some great work on. Hopefully you'll talk about that more. Like it's more than just productive lending. It's also a question of smoothing cash flow, making people able to be resilient in the face of unsteady cash flows, which is what many individuals as well as businesses struggle with. It's also about being on a trajectory where you're able to build a credit history and then demonstrate credit worthiness and graduate to other products over time. Like there's a lot of different ways, I think, of thinking about whether you're better off from your financial health. It goes way beyond APR, and it always has. I mean, going back to, I talked for a minute about 2004 when I was doing micro lending in Azerbaijan. We were charging really high interest rates, and that was Save the Children. Like, my view on interest rates is that it really is market competition that it brings interest rates down. So it is a commitment to serving a customer well, and more folks really grappling with trying to do that is going to drive costs down. I think that for us, when we look at predatory lending, it's about disclosures, transparency, practices, et cetera. we still see, and increasingly because of the complexity, the costs you went through, like there are many people who take financing that they do not understand how expensive it is because it is intentionally obfuscated. And they end up taking much more expensive financing than cheaper financing that is available to them because they believe that the financing they're taking is cheaper when it is
Right.
in fact not. And that I think is something we have to deal with.
Yeah.
Maybe
yeah, go ahead.
Go ahead, Jason.
No, go ahead.
I was going to take a stab at taking some of what Jacob just said and throwing out maybe like 3 principles of what is not predatory finance.
Mm-hmm.
So to me, there's the proactive and there's the protective elements of what good lending looks like. We define the proactive part, the intention behind the credit, as Jacob said, as resilience. So
Yep.
when we look at a prospective startup, whether we're really early stage investors, right? So when we look at a very early stage business that intends to provide credit either directly or indirectly, we really try to immediately make a through line through what they're offering and whether or not it's driving financial resilience for the end customer. And the end customers we care about are small businesses and low to moderate income consumers. We're U.S. focused, as I mentioned right now. We're very specific about what financial resilience means. It is, are you building new sources of short-term cash buffer, so net income? Are you building long-term net worth? And are you lowering risk along that path? That's it. So if we can't make a through line, not to access, not to is a product being provided at all, but is the impact of that product to actually generate net income, net worth, or lowered risk, we won't invest. We have to be able to show that through line. That's the proactive part. On the protective part, and by the way, we get a lot of this thinking from CFI in terms of consumer protection.
Thank you.
On the little plug, but on the protective part, it is really about pricing and transparency. On transparency, I think it's okay for friction to come out of the process, but you have to be able to make an apples to apples comparison if you want to. And that is, as Jacob said, impossible for many, many financial products right now. So you have to be able to be given the information to make an apples to apples comparison. And then on pricing, look, like Jacob said, I mean, we're not sort of dogmatic about APRs being high or low in an absolute sense. I think what we're looking for is pricing better than the competition for this customer group in this moment? Is pricing set to lower over time according to 2 vectors. One is as the consumer or small business, the borrower proves themselves over time. And then second, as the company grows, again, we're investing really early, as the company grows and ultimately is able to access lower and lower costs of capital, is some of that being passed over to the consumer. So those are sort of what we're looking for in terms of pricing very specifically. So pricing, transparency protectively, and then resilience proactively. That to me is non-predatory lending.
No, that's great. And actually on pricing, I think it's really hard to be prescriptive because different markets have different rates and risk that needs to be factored in. But what we see with the lack of transparency that comes in, especially with embedded finance or this, removal of all friction, is 2 things. One is that, like you pointed out, people don't really know the terms and conditions and they don't know how much they are borrowing and they're unable to compare. So there's that. And then there are some people who are particularly more vulnerable. And a few years back, we categorized the different kinds of vulnerability. And, some of it could come because of low income. Some of it could come because of lack of digital awareness and lack of information. Some of it is just because of people's state of life at that point in time. They've experienced a massive shock. They have to make a split-second decision and they end up taking a loan that they really shouldn't have taken. And so we've been experimenting with this idea of positive friction. So friction that's intentionally introduced in consumer journeys so that, people slow down a little bit And it's helpful because then lenders, that not all lenders are out to take advantage of consumers, but there are some lenders that want to take advantage or have set up their systems in a way where consumer vulnerabilities can be exploited, and that kind of gets reversed. And the reason I bring this up is because I want to hear from you, various examples of predatory lending that you might have seen, without naming institutions. But what are some of these egregious examples, which it's really helpful for us to hear, because then we can turn it on its head and find out what's the vulnerability and what's the consumer bias that's caused, and then how can we build safeguards.
Yeah, I'm happy to start there and talk about some of our work in the United States with small business lending. People often think United States is so well regulated, especially compared to some of the emerging market schemes. But in fact, there's massive loopholes here in the United States when it comes to small business lending versus consumer lending. So, for example, when you're a consumer and you get a credit card, you get financing for a car, you buy a house, you get a standardized disclosure called the Schumer box, right? You all probably are familiar with it, what it looks like. There's APR, there's total amount of money that you're going to pay over the life of the loan, et cetera. But that is because of truth in lending, which applies at the federal level for consumers. There is no truth in lending for small business lending, because the government sees it as a private contract between two commercial entities, right? And that's smart that the government doesn't want to insert itself into every contract between commercial parties. But when it comes to small business owners, often they are not any more financially sophisticated than a consumer, right? And then on the other side of the contract between two commercial entities is a lender that was created to hide the terms of the financing, obfuscate, and potentially even take advantage. So in the United States, there's a group of lenders that we generally refer to as merchant cash advance. And there are some good companies that are doing merchant cash advance. There's nothing about the product that is inherently challenging, but essentially it's a way of doing a revenue share of future receivables. And so it is not technically a loan in its purest form, although sometimes it can be structured as a loan. And often the way it'll be marketed is a lender will say, there is a 15% factor rate, meaning that if I give you today $10,000, you pay us back 15% of that, right? Percentages are very intuitive. We all understand markup, interest rate, things like that, right? What is very difficult, and I think often is behind much of the obfuscation, is time value of money. That is not intuitive. And that's often what we see is there's a lot of upfront fees, and people compare products. They're comparing the absolute rates. They're not comparing the time that you repay that loan, because that is such, that is one of the two core elements of how you think about cost of financing. It's a rate, but it's also time. And so what ends up happening is the way that it's sold is generally through a broker network, where the broker is highly paid, very similar to the subprime mortgage way that those things were sold. And the brokers are paid a significant commission based on that merchant cash finance. So a small business, someone walks in and basically tells them, we can get you financing. How much will it cost me? 15%. Okay, that seems much better than this online loan that maybe is available to me for 20%, right? So they end up taking the 15% financing. What they don't necessarily understand is that the way that the calculation is of the repayment schedule is based on a certain amount of repayment flows. So it could take them only 90 days to repay at a 15% rate. If you're repaying evenly over 90 days, it has a weighted average life of about 45 days. So if you take a 15% rate over a 45-day period, it is well in excess of 100% APR, right? So that person is taking a interest rate that is in triple digits and turning down a loan that might be offered to them at 20%. Like just to get into sort of how this works generally. So someone is taking that loan, and there typically was not a requirement to disclose APR. APR is the annual percentage rate. It factors in everything, fees, et cetera, to come up with an estimate. Now, it's never purely accurate, right? Because if you pay the loan faster, if you take longer to pay the loan, the rate will never be what it is as it's estimated. But it's the, as you mentioned, Vikas, it's the most apples to apples way of trying to get at taking two very different things and putting them together. We were part of the Responsible Business Lending Coalition that put out the Small Business Borrower Bill of Rights in 2015. And we've advocated and have actually gotten passed into law now in several states like California, New York, and some others, their own requirements for different financing products to have to disclose this type of APR, as well as, you know, really have, there's many other things that we want to do about responsibility, but this transparency piece is key. And it's not that APR is always perfect, but you just have to be able to have some language to be able to compare products that can be so dramatically different. And, you know, we are fighting at the state level across the United States to try to get this enshrined into law. But there are many companies, our portfolio companies and others, that are doing this on a voluntary basis, because the best way for them to actually sell their product is to show the customer how predatory the alternatives are. So it's really interesting. It's baked into the competitive business model.
Jacob, can you talk about whether those are, you expect those to be principles, like business principles over time, or is the idea to actually lead to fundamental legal or regulatory changes?
I think it really depends on the market, right? So for example, transparency on APR is something that can be enshrined into law and have regulatory practice. Right now, it's a certain number of states. You know, the federal government could potentially act on that, and it's something that has bipartisan support, right? Because small business is something that is a very much enshrined into the key principles of both parties. There's bipartisan support that we've seen at the federal level as well as at various states among business, both on the business side as well as the consumer and small business protection side. So that is something that I think really can be integrated into law. There are some things, though, that are really challenging. So when you think about another one of the principles that we have in the Borrower Bill of Rights, which is looking at putting ability to pay into a responsible product, right? That there is an assessment as to someone's ability to pay. There was a attempt, I think it was during the Obama administration, for the payday lending law, that there would be an ability to pay test. It was very difficult and ultimately died to get that implemented into practice to enforce that lenders would do that. So I think there's a balance between, you know, pressure that we have as investors, as society to put on certain types of practices, and areas where there can be real clarity and that are put into law.
And what do you think is more, I mean, I'd like to think that companies voluntarily, you know, adopting some of these practices is helpful. Regulation, I think, has its own space, but we're also entering a world where I think we're going to see less and less regulation, not just in the United States. I mean, everywhere. I think there's a pushback on regulation in general. How do you think you, as investors that want to be responsible, how do you strike the balance between, I guess, innovation, growth, and consumer protection?
Yeah, I'm actually curious, Jayshree, to hear, and at a high level, what you're seeing in other markets. I mean, in the United States, we are in a period. Rules sort of come and go with administration. I'd say we're in go right now in terms of whether or not the federal government and the entities that have typically been involved with the financial services, in particular the CFPB, the Consumer Financial Protection Bureau, are doing much in terms of protecting consumers. They are not in this moment. But political winds change. Regulations. Now that we've been doing this for long enough, you can see they sort of come and go. I think as an investor, as an operator, you have to have principles, the sorts of principles that we've been talking about, and be really try to be really consistent on those. Part of that's because as administrations change, there's pretty long-term statutes. So you can actually have liability for things you did in a previous administration if you act unfairly toward consumers. But then more importantly, it's good for, as Jake was saying earlier, it's good for the end customer. It's good for the company to be sort of customer aligned. Ultimately, I think that's ultimately the pitch behind the Responsible Lending Coalition. So we try to guide our companies to adopt the sorts of principles I mentioned earlier around price, around transparency, around building resilience, because sometimes rules can hurt when it comes to sometimes interest rate caps or overly blunt instruments. One of the things that in fintech in particular that is hurting in this moment is the sort of push and now pull back of open banking rules in the United States. At the end of the Biden administration, the CFPB essentially came out with a set of rules around ensuring that consumers can control and decide when to share their own personal banking information. That sort of went away temporarily, at which point some larger financial institutions sort of stepped in and started proposing essentially that they would charge for consumers to be able to share that information. That is, there now may be over the next year or two new open banking rules put back into place. So it's sort of hard to know where these things will end up. You really, as an investor, as an operator, have to lean into being consistent on principles that are going to work regardless of political cycles. That's clear pricing, aligned incentives, real resilience. That's what we try to push for.
Yeah, and Peter has a great question in the chat about predatory lending and, how applicable is the argument of extracting short-term profit from consumers at the expense of driving long-term financial value. And I actually had I did want to ask you both as investors. I mean, it's one thing to say that, yes, there is long-term business value, but often this business value is so long-term. And similar to Peter, how do you convince your other follow-on investors or fellow investors that there is value in the short term to focus on being responsible?
And I don't think you can convince anyone of these things, right? Like I don't think our job is to convince people. Like I think ultimately, you have to find the innovation and the opportunities to do it better. And that's really what I think why so many of us who were working in microfinance are in fintech these days, right? Is there was this innovation around group lending, for example, that opened up access for a lot of folks. But we mentioned the Andra crisis, et cetera. Like there are some significant downsides of that model as well, which we continue to see, grappling with. I think that look, in lending, it's a fairly shorter cycle of sort of what you're referring to as long-term business creation, right? It's credit. And so if you charge, and to Peter's question about extracting a lot out of consumers in the short term, it won't end well in a pretty quick amount of time, right? Like now there are businesses that make plenty of money by extracting in the short term and then continuing to move on to other customers, right? The challenge with those business models is one, they rely on a lack of competition because you are a lender that is not that attractive when you actually have a vibrant set of other options that see the customer as an attractive customer. Like in many ways, I think the thing that we've all accomplished over 20 plus years of financial inclusion is showing that, in fact, these are great customers that we all should want to serve. And there's plenty of terrific business opportunity in serving this market. It goes back to the fortune at the bottom of the pyramid that Professor C.K. Prahalad wrote, right? I mean, there is a lot of business logic of going after this market. Now, there's decisions that every company makes as to how they're going to do that. Like, are you going to ultimately provide products that are really benefiting the underlying customer and allowing them to be in a better financial position? If so, they will buy other products from you. They will grow with you over time, right? Yes, you will have to lower your pricing potentially, but you will also have a much bigger and healthier, stable customer base. If you are short-term extracting a lot out of your customers, get ready for adverse selection, because the customers that stay with you are the customers who will not necessarily be in a position to graduate. You are trying to beat back competition. You are trying to hide your terms so that you can compete with others who are offering better products. And so it works for as long as it works. But the credit quality that you end up getting, the loss profile that you end up getting, the cost to continue going after and finding new customers all the time, like you're on this treadmill and you're always trying to extract enough. And so I think there's going to always be lots of examples of folks who are doing the short-term model, folks who are trying to build a long-term business, but the really generational companies that entrepreneurs that Vikas and I are backing, what they're trying to build, they're doing it because they want to really help an end customer base succeed. And that's the value of the business over time. Like their success and failure is tied to the success and failure of their underlying customers. And so I don't think it's that long of a feedback cycle.
Yeah, I agree. And look, the framing of this panel is predatory lending, but Jacob and I are on this panel because we invest in innovators that are doing the opposite of that, that are providing real value to an end customer and growing. I mean, every company that I invest in, we expect to scale dramatically and serve many, many millions of borrowers if it's a credit business. So yes, we have been sort of talking about the risk that technology creates, but technology creates incredible opportunity. And if lending businesses are in some ways pretty basic, right? To create an advantage in a lending business, you need to understand the customer better than others do. You need to be able to pay less for the money you borrow, right? Have a lower cost of capital over time. And you have to be able to distribute and ultimately collect more and more cheaply. And across every one of those vectors, there's incredible innovation happening that should allow more and more lenders to provide more and more borrowers good product without having to skirt these principles that we're talking about. We're supporting businesses that are, for example, providing HELOCs and HELoans to low-income borrowers for the first time that are finally sized the right amount, so the borrowers actually have an ability to pay. They use AI to much more accurately underwrite these borrowers and size and price the loan appropriately on the underwriting side. And then on distribution, they work with contractors to actually distribute the product, and they ensure, given with insurance and the right incentives in place, that the loans are actually being used for productive purposes that are actually going to build long-term net worth for the end borrower. None of that would have been possible even 5 years ago. But technology is changing so rapidly. You can do these things, build a really great, hopefully we hope really profitable and scaled business while still being really responsible.
Mm-hmm. I think we have less than 10 minutes left, and I have two questions for both of you. One is, looking back, and you call this the third wave of financial inclusion, but looking back, what's the one thing that we should be careful to avoid so that we don't fall into the same, pitfall? And, I think some of it you just responded to, but what should the industry think about? And beyond you, Jacob, and beyond you, Vikas, what is the one takeaway that you'd give people that want to be responsible on what to avoid from wave one and wave two, if we have to make wave three succeed in terms of financial outcomes and resilience and better financial health? And then the last question is, if you had a magic wand to change the industry, what would you use it for?
I'm happy to start on the one thing to convey. Those are both great questions. I think that, often we create false divisions around, how the use of proceeds, like we think like, oh, consumer financing, people are going to go out and buy TVs they can't afford, versus small business loans, which is super positive. I think when you're an operator on the ground, you see how fungible money is. You see small businesses using the loans for their personal households, and you see how much consumer finance is being used also on income generating activities too. So, I think we need to be a little hesitant to be paternalistic for the way that capital is used, and especially taking, people who are on the ground, running businesses, running households. They are highly capable at understanding their finances. In fact, I would say that most of the borrowers on the lower end of the income spectrum manage a budget much better than people on the higher end of the income side, because they don't have any margin for error, right? So what we need to focus on is really the product and the way that it interacts with the customer. So it should all go down to the product level. Like, understand how the customer uses it, how they're getting information, how they're able to make decisions, how it really integrates into their life. Like, don't go in with assumptions, go in with curiosity and a desire to really understand and be educated about every single product that you see with its customer. Because at the end of the day, like, what we want to do is we want to empower them with good information that is, transparent. We talked a lot about all the ways that they're being tricked and those are all very real. But we want to focus on empowering people with information so that they can make good decisions. I think we want to avoid thinking that we know best and making the decisions about what products are good for them. Like, that would be my soapbox that I would stand on and say the one thing that I would want to convey is it's all about the product and it's all about your customer. That's
great. Vikas?
I don't know which of the two questions I'm answering, but I mean, I know this is a financial inclusion week panel, but as I think about each of these waves, I think the microfinance wave and the Fintech 1.0 wave were financial inclusion waves, which was, I think, net incredible progress for the world and for the industry, but also sometimes led us astray because we focused on inclusion, we focused on getting more people financial products and services, and not necessarily thinking about for what. Mm-hmm. And what we're really trying to push for now with Resilience VC and folks like CM and other partners is answering that Fintech for what question. And in our view, the answer should be resilience. And if the answer is not financial resilience, then you're probably not doing the right thing. So I would just encourage everybody who's in this space to think about how credit is being used and how it's leading to one of these core metrics of resilience, which we really think of as can you get through the short term and build for the long term? So that would be my ask, and we're thrilled to partner with people that are thinking along the same lines.
No, and it's a great way to actually end this panel as well as day two, because in a way, what we've been discussing through the past 2 days is how do you build resilience for people that are facing a time of uncertainty. And the reason we phrased it that way is because I think a lot more people are included, but that doesn't necessarily affect their ability to deal with life shocks. So what you both just presented is exactly what we want the audience to think about and the sector to think about. But on that note, I'd love to keep talking, but unfortunately, Abby is going to cut us off. So thank you very much for being part of this panel and for agreeing and indulging my different questions. And I look forward to seeing you outside of this panel.
Thanks, Jayshree.
Thank you so much, Jayshree, for a great session. Vikas, really appreciate being with you today.
Same here. Great to see you both.